So I will leave Ben to continue dealing with the IT side of things and just say welcome everybody to Bristol Talks Economics. Tonight we're hugely honoured to be welcoming Jacob Goldstein, who's going to be talking about his book Money. For those of you that don't know him, you may know his voice because he works for Planet Money, which is one of the absolute top economics podcasts. Thoroughly recommend it. And his book, I had the pleasure of both reading the book and reviewing it for the New York Times this summer, and it's absolutely brilliant. It's based on stories. So if you're interested in money, if you're puzzled about money, if you don't understand money, I really recommend it. We'll put a link to that review on the YouTube that we're streaming live to. If you have questions during the session, please put them in the Zoom Q&A or in the YouTube chat box. And I'm now going to hand over to Ben. Ben is one of our third years here at Bristol, and he's going to give Jacob a bit of an interview about the book and about his career. Jacob's then going to present some of the stories from the book, and then we'll open it up to questions. So without further ado, let's welcome Jacob to Bristol Talks Economics.
Thank you very much indeed, Richard, and welcome, Jacob. Apologies for the slightly late notice there, but it's absolutely brilliant to have you with us tonight.
Thanks for having me. I'm sorry I'm a little sweaty. I was just getting back from a jog when you emailed, but I'll feel great in an hour. And so, no, it's great. Thank you. And Richard, let me say, I haven't spoken to you ever, but I thank you on Twitter. I'll thank you now for writing such a kind review in the New York Times. Obviously, it's great. It's great for me. I really appreciate it. Thank you.
Yeah, it was absolutely brilliant to have you with us here, Jacob. And I just want to say as well, I've also recently read your book, and it was incredibly entertaining, but I knew that already from listening to you on Planet Money that it was going to be very good. But you weren't always in the economics game. You initially started off as a health reporter in the early 2000s. Can you talk a bit about why you decided to make the shift from health to economics after the 2008 financial crisis?
Sure. I mean, there's a couple versions of the story. The sort of true version of the story is I was working at the Wall Street Journal paper in the United States, as you probably know, covering healthcare. And the paper was changing, the ownership had changed, and I felt like kind of at an end. And I really liked what Planet Money was doing. I had listened to them and I thought it was really interesting. That's like the boring career version. The kind of fun narrative version of what happened is the story I tell in the book. And it's also true, has the benefit of being true, is that it was 2008, it was the financial crisis. And, you know, the stock market was down and real estate was plunging in the US and around the world. And I went out to dinner with my aunt, who is very smart and charming and funny, and also a very successful businesswoman who'd made a lot of money. So we're at this fancy restaurant in Manhattan, and the kind of financial world is falling down around us. And I asked her, you know, all of that money, those hundreds of billions or trillions of dollars that have sort of disappeared, right? The stock market is down and people are talking about like $1 trillion or whatever it was, billions of dollars wiped off the face of stock market values. I said, all that money, where did it go? Like, what happened to it? And she said, look, money is fiction. Like, it was never there in the first place. And so that to me was like an interesting big moment, you know, because I had been, I studied English in college. I never studied economics. You all probably know more about lots of economics than I know still. And I had kind of maybe an aversion to money, like a little bit of like kind of center left, you know, vibes of like, oh, I don't want to be greedy, like I'll get enough money, but I don't want to be that interested in it because there's something bad there. I had this vague moralistic feeling about it. But so I became more interested in it. And then I went and worked for Planet Money and started doing a lot of sort of history and just really basic, like what is money kind of stories. And I got more and more interested.
I'm very happy everything is in English. Shareholder meetings are all in English, very nice atmosphere. We are close to Rotterdam.
Sorry about that. I think someone's...
Shout out Andrea.
And you are pioneers, like the pioneers of the cars were in Europe.
Right, Andrea is gone. Sorry about that. But you were touching there on your work at Planet Money, and over the last decade or so, Planet Money has become incredibly successful, recently celebrating its 1000-ish episode, I believe, in May. I was just wondering whether you could talk about perhaps what you think is Planet Money's winning formula. We're all, well, most of us are economists here. We love an equation. I believe Planet Money has a specific formula as well that it likes to use.
Yes, and it is not equations. It's basically, I mean, well, there's different ways to make stories work. I mean, on one level, the two things I'm generally trying to get into stories is insight and delight. And, you know, I think most news stories are going for insight, although it's remarkable how often they don't get it. I mean, it's hard to get. Like, you want to get, like, what is something people don't know already, or like sort of know already? Like, a lot of stories, there's new information, but you kind of knew it already. So that's one way of thinking about it. And then delight is just, can it be a little bit funny or a little bit surprising or something? I mean, quite often, the sort of classic Planet Money story, there's a narrative. You know, there's a person in a place doing a thing, they have some problem, and then they solve the problem or they don't, and you kind of land somewhere. And then in combination with the narrative, there is some big interesting idea about the world, or about, you know, the nature of regulatory capture, or the meaning of arbitrage, or whatever.
Could you maybe touch on one of your favorite stories or characters that you've met on your time at Planet Money? Perhaps obviously the famous T-shirt to explain global trade. Yeah,
the T-shirt project was great. I mean, my role in that was fairly minor. But basically, we made or I shouldn't say that, I just didn't get to do as much glamorous travel as my colleagues. That's the way I mean to say it. So the idea was, you know, NPR stations and programs will sell merch, you know, they'll sell tote bags or T-shirts or whatever. And so our notion was, let's sell a T-shirt, but let's do a whole project about the making of the T-shirt. And it's a way to talk about, you know, global supply chains and comparative advantage and lots of fairly straightforward economic things, but in a very literally tangible way, right? And so we wound up, you know, using cotton from Mississippi, and there were men's shirts and women's shirts. The men's shirts were made in Bangladesh and the women's shirts were made in Colombia. And we actually sent reporters and camera people to all the places. The cotton was spun into yarn in Indonesia, which is interesting because it's actually quite capital intensive. So that's why they do it there. And, you know, making the T-shirts is still done basically by hand on, you know, old-fashioned sewing machines. So that's why it's done in places where labor is very cheap. I mean, I did a bunch of writing and editing, but like semi-trivially, I just went to Miami. It was nice to get a trip to Miami, right? I mean, it's not Colombia, but I went to Miami where the T-shirts came in on a ship, and we did a story about shipping containers and what an innovation that was in terms of efficiency. So yeah, that was a great project.
Yeah, and Planet Money has always been very innovative in how it's done things. Because on a podcast, it's got to be very audible rather than visual. For example, an opera singer displaying a graph, I think, was one of the most interesting examples of that. But just sort of going more towards your book now, how is the process of writing a book quite different to writing a podcast script? Of which sort of senses are you targeting, obviously, differently?
That's an interesting question. I mean, sort of selfishly, the biggest difference for me, frankly, was how solitary writing a book was. Like, I got really lonely when I was working on the book. Planet Money is a really collaborative environment. I think podcasts are in general. Certainly Planet Money is a very, it's very collaborative. I mean, you work on things together, and I like, almost, you know, somewhat neurotically, kind of constantly asking people about what I'm working on, and how about this, how about that, and I got this tape from this interview, and how, you know, how is this structure going to work? So that, you know, internally was the most striking thing. Obviously, a book is much longer, although I structured the book in a way like a series, as Richard said, like a series of stories. So that part was familiar. You know, one thing that was nice in writing the book is I didn't have to think about who's going to be doing the talking, right? The way we make the podcast is typically go out and talk to different people and use their voices. And for history stories, I mean, you can go talk to historians, that's okay. And I like doing history stories, but there's a kind of, I don't know if elegance is the right word. It's much smoother to just be able to write the story, right? And have it all be basically in my voice. So that was a nice difference in the book. But in a lot of ways, it wasn't that different, frankly. I used the basic storytelling mechanisms of Planet Money of like ask a question or set up a problem and have somebody go out into the world and do things and then try and land it with some idea.
Yeah, I think definitely for me, the thing about that links Planet Money to your book is the fact that you had great characters in there. So I think the epitome of that is obviously John Law, a character in your book, someone who went from being a convicted murderer to essentially the Prime Minister of France. Could you give us a bit of a deeper insight into John Law's life and how he shaped money?
Yeah, absolutely. I mean, let me ask you, just because I'm curious, because you're in the UK. So I had never heard of John Law before. I'd been covering economics and money for like 10 years, and I was interested in the history. And I'm shocked at how unknown he is here. Is he better known there? Like in school there, does everybody learn about John Law?
See, no, I don't think he is at all. I'm seeing Richard shaking his head there.
Yeah.
Yeah, I mean, I don't know whether it's due to the fact he's in Scotland and Scotland's trying to become independent.
Yeah, right. I should ask
Uh,
somebody at the University of Edinburgh if I talk
no,
to them.
but yeah, no, it's a serious point because obviously Adam Smith is obviously very well known. But then I was even looking up because something similar essentially to John Law blowing up a big bubble. A century later, General Gregor McGregor had the Poyet scandal, which again it seems very similar. But again, I think these figures are not very well known in history. Everyone knows about the Mississippi bubble. Everyone knows about the South Sea bubble.
Yeah,
perhaps, but you don't know John Law, the character, and the rich history that goes into him.
So he is extraordinary. So yeah, so he's born in Scotland in the 1600s, in the kind of late middle 17th century. Comes of age, moves to London and becomes a sort of man about town, a beau in the language of the time. And I don't know, they still say beau, not really here. But it basically means, he's gambling and he's drinking and he's chasing women. And then, as I guess one did, he has a duel. He fights a duel with another beau and he kills him. And he gets convicted of murder and he gets sent to jail and he's sentenced to the death penalty. They're going to hang him. Maybe, people still duel and maybe he's going to get off, maybe he's not. But then he escapes from prison and apparently it's kind of an inside job. It's unclear exactly what happens. Maybe somebody drugged a guard. It's fun to think. He gets on a boat to Europe and a lot of really interesting things are happening in Europe at this moment. I mean, it's the Enlightenment, that's interesting, but in particular in economic history, a lot is going on. So, I mean, one thing is probability theory is new. Probability theory started with gamblers, Pascal famously. And so, this is like 50 years after that. So probability theory is kind of starting to spread and Law is really clever, good at math, and apparently sort of learns probability theory, still not widely known, and becomes rich as a gambler. So this is the first thing, he becomes rich as a gambler. Also, he is clearly looking at all of these kind of economic, financial innovations that are happening. This is the moment, certainly in kind of Western Europe, when the origins of modern financial capitalism are taking shape, right? So he goes to Amsterdam, where they have the Dutch East India Company, and they're really the first kind of multinational corporation with stock and a stock market, and they also have a local bank, the Bank of Amsterdam. And so the Dutch are doing great, basically, because they have kind of mastered financial capitalism. And, around the same time, the Bank of England has started, right? That's 1690s. Actually, right around the same time when Law is like on trial for murder is when the Bank of England is launching. Paper money is new to Western Europe at this time. The Bank of England's banknotes are starting to become a thing. And so Law sees all these things and sort of has this vision for creating a whole modern financial economy, because these sort of technologies or these practices are not that widely spread. And so first he goes back home to Scotland and he actually writes this sort of treatise making this case for Scotland to become a kind of modern financial powerhouse. And he says, like, look, the Netherlands should be a crappy country. He's like, their land is bad and they border the Germans and there's all these reasons they should be poor, but they're rich because they're doing money and finance and capitalism, right? Scotland, on the other hand, should be rich. We got nice land and we're out here in this island and blah, blah, blah. But we're poor because we're getting money all wrong. But the Scots don't listen to him. So he goes kind of wandering around Europe and like pitches it to, I don't know, in Turin and in Vienna. And finally in France, he finds a taker. France is being run by a regent, the Louis, one of the Louis 15, I think it's 15, is a little boy. And so the regent, who is this duke, the Duke of Orleans, basically lets John Law set up shop in France. So Law creates France's first modern bank and it starts printing the first paper money. And Law also gets control of France's territory in North America, which is giant, which is like the whole center of North America, basically, along the Mississippi River, creates a trading company like the Dutch East India Company or the British East India Company, for that matter, the Mississippi Company, people call it. It has stock. By the way, they named the sort of capital, the little town at the mouth of the Mississippi River after his patron, the Duke of Orleans, that's New Orleans. And then his bank is printing money and people are using that money to buy stock in his company. And there is this incredible boom, and the price of the stock goes up and up and up, and people are flooding into Paris to trade the stock. And there's this one little narrow street in Paris they actually close off, and everybody's getting rich. Jean Law is like now one of the richest men in the world, and they make him basically, as you said, the prime minister of France, the whatever controller general of finance, and they coined the term millionaire. People are so rich, they need a new word for it. And then finally, it all sort of starts to collapse. There starts to be inflation. And actually, at one moment, Jean Law tries to basically make fiat money. He essentially says, you can no longer redeem my paper money for gold or silver. And everybody freaks out and they chased him out of France. And he's gone forever. And he lives in Venice as a gambler and dies.
It's a pretty good life.
It's an amazing life, yeah, ups and downs, but it must have been interesting and probably fun a lot of the time.
But yeah, I love the way you tell that story, but then you also do draw some quite deep economic lessons from that at the end. Could you maybe talk a bit more about the institutional push and pull, which you think helps the creation of money?
Yeah, so I mean, there is, to the extent people know about Jean Law, I feel like the basic story is that he is, a shady banker, a con man, somebody who just sort of sailed into France and like BS'd them into letting him get rich and then leaving them with a destroyed economy. And I actually do think that is not entirely fair. I mean, in a lot of ways, he was basically right about money. He was ahead of his time. He saw where the world was going. He was right that having banks and money, paper money, and corporations that everybody can invest in, these are fundamentally useful economic institutions. I mean, I think there's an interesting argument that what really got Jean Law into trouble was that he had too much power, right? France was an absolute monarchy. So once he got in with the regent, he could do whatever he wanted, and there was no kind of competing interests. And, and obviously England or the UK by that point had its own South Sea bubble, basically contemporaneously with the Mississippi bubble in France. But it is the case that England at that time had more kind of what we would call checks and balances than France, right? Parliament had power relative to the king. The Bank of England was this interesting institution that had a set of legal claims and a right to be paid back basically under the law. And the UK clearly fared better than France in this era. And I do think one of the useful things to think about in terms of Jean Law is that this idea of competing interests that we have certainly today, in any Western country where you have, the banks are a seat of power and the government is the seat of power. And you have, citizens, and within the government, you have people fighting. Like that fight itself often is presented as like, oh, it's a problem. The problem is the banks have too much power. The problem is the regulators are being overbearing. But in a way, to me, those complaints, the existence of those complaints grounded in some amount of real power is a promising sign, right? A sign that there are competing interests. And I think those interests can do a lot to keep any one interest in check. So obviously we still have financial crises. It's not an entire solution, but I do think dispersed power is useful for stability in the long run.
Yeah, and I think for me, sort of my prior is that from what we've learned at university, we've learned about Acemoglu and Johnson's sort of institutional theory of inclusive economic institutions is what builds a prosperous society. I think, the Mississippi bubble and the South Sea bubble is a brilliant natural experiment almost of when you have more inclusive institutions with more decentralized power, then you've had a better outcome with money. So that was really interesting for me to read about.
Yeah, when I was working on an earlier part of the book about the rise of coins and the ancient Greeks, I actually came across a little Acemoglu and Robinson argument about that era in the same, using their kind of classic language about institutions, where they talked about the, what was the name of the earlier Greek civilization, like before the classical Greeks, where they had a sort of a tribute economy? Was it the Minoans, I believe? It's not in the book, so I don't remember it. But basically, very early on, and this is obviously thousands of years earlier, one of the economic models was a tribute economy, where essentially there's not much of a market, and there's debate over how much of a market was there, but fundamentally the main sort of mechanism was not market exchange, but rather this kind of top-down tribute and redistribution. So the king or the sort of priest or whoever would come around and take everybody's stuff more or less. And the kind of temple was a kind of proto-city hall, and they would decide who got what. And if I recall correctly, Acemoglu and Robinson were comparing that unfavorably with the sort of, well, basically democracy, that rose up in Greece a little later.
Yeah, definitely. And the most recent book, they talk about shackling the Leviathan of the state. And I think that's exactly, it's the checks and balances on the absolute monarchy, which, could have helped France out. But moving on. So there's so many great stories in your book, but I think the next one I really want to touch on, slightly bringing it into a topical example of jumping the species barrier. You have an example in your book of money jumping the fence and becoming dangerous. So could you perhaps talk about Harry Browne and Bruce Bent and the mutation, which is the money market fund?
Oh yeah, great, sure. So that is much more recent. So that story starts in the 1970s. And the context there was that at that time in the US, it takes place in the US, and at that time in the US, there were quite strict regulations on banks that came out of the Depression. So, in the Depression was the first time when banks in the US got a deposit insurance from the federal government. And kind of in exchange for getting deposit insurance, the federal government imposed lots of restrictions on banks, including caps on the interest they could pay to ordinary depositors. Checking accounts were maybe 0% interest. Certainly savings accounts had a cap on interest. But at the same time, you could get a higher interest rate on short-term US government debt, treasury bills. And you could also get a higher interest rate on relatively short-term time deposits, certificates of deposits at federally insured banks. So, it's 100% safe money. It's, full faith and credit of the US government. And so what these guys, Bruce Bent and his partner, realize is they could create something that's a lot like a bank account, but that pays higher interest, right? So they invent the money market mutual fund, and you put your money in and your dollar is always worth $1. They use this new kind of accounting. So unlike regular mutual funds where it feels like an investment and maybe it's worth more and maybe it's worth less, in a money market fund, your dollar is always $1. So that's very bank account-like, but they can pay you more interest because they're turning around and investing your money in T-bills and in certificates of deposit. So it's very bank-like, right? They're taking your deposit and they're lending it out, classic bank behavior. Your dollar is always $1, classic bank feeling. Pretty soon you can write some checks on your money market mutual fund. So it is very money-like, but crucially, it is not within this banking regime. It doesn't have federal deposit insurance. The money market funds aren't subject to the same kind of regulation as banks, but everybody loves them because it's like a bank account, but you get more money. Like, what's not to love, right? So money floods in, hundreds of billions of dollars. And as these money market mutual funds get bigger, other institutions start to offer them, they need new assets to invest in, right? They're taking, it's not depositors, but it's investors' money, and they're turning around and they start, not Bruce Bent just yet, but other mutual funds start doing other things with the money. So they'll buy commercial paper, which is essentially making unsecured loans to corporations, short-term loans. Then later, as the kind of finance starts to take off in the US, and investment banks start to get bigger, they start to lend to investment banks in the repo market. And then you get to the 21st century and you have the great housing bubble, and money is flowing through money market mutual funds and into the housing bubble. Basically, the non-bank lenders that are doing a lot of the mortgage lending are funded by money market mutual funds. And I should say other kind of similar institutions, this kind of whole universe of non-bank but bank-like things, right? Which comes to be called shadow banks, which is nice and dramatic, but it just basically means people who are doing things like banks but aren't regulated by banks. And weird conduits, the conduits that regulated banks are setting up are actually a way to get shadow banking money kind of flowing through. And then finally, Bruce Bent, by the way, the whole time is like complaining about other money market funds being too risky and doing weird things with people's money. But it comes September of 2008, and Lehman Brothers goes bankrupt, which is the great kind of critical moment of that 2008 crisis. It turns out, we learn, I mean, it had been public before, but nobody paid attention, on that day in September 2008, when Lehman goes bankrupt, that this original money market mutual fund that Bruce Bent is still running, whatever it is, 40 years later, was lending money to Lehman Brothers. They were holding Lehman commercial paper. And, it wasn't that much of their money. It was like 1% of it or something. But the whole notion of a money market mutual fund is you put $1 in, you get $1 out, right? It's not like, oh, this is an investment, maybe it'll go up or down. So rationally, once people realize this, everybody that very day starts trying to pull their money out of this money market fund, of Bruce Pence's money market fund. And it is essentially a bank run, right? And it is amazing. You can see it, you know, you don't see people lined up on the street because it's not that kind of a bank. But court records later came out, and there were these calls that they recorded for regulatory purposes. And you can hear these guys at the money market fund being like, fuck, now this person wants $1 billion and we don't have it, right? They have to sell assets in order to pay the people who want their money back, the investors who want their money back, and they can't do it. It's just classic bank run. And so they end up not being able to give everybody their money back. In the parlance of money market mutual funds, they break the buck. And that prompts a massive run on basically all prime money market mutual funds, which adds in a way that I think was largely underrated because so many other things were happening, adds a tremendous amount of strain to the financial system. And the president at the time, George W. Bush, just a couple days later, that same week, steps in and says, okay, the federal government is now going to guarantee every dollar that people have already in money market mutual funds. And that stops the run. But like, that is an incredibly sort of momentous and in many ways troubling moment, right? Because money market mutual funds had not been paying into any kind of insurance the way, you know, regular banks pay a premium to get deposit insurance. They had not been supposed to be guaranteed. They had been supposed to be a risky investment and maybe you'll lose money, but clearly nobody thought of it that way. And once the government does that, they're basically saying, okay, finally, we admit it. Like, a money market mutual fund is like a bank deposit. It is basically money. We just haven't been regulating it as such.
Yeah. And you touched briefly in your book, sort of came out during the coronavirus crisis. Do you have any more thoughts now on where sort of the next money-like currency or whatever will come from? Is it US Treasury market, or is it something else you're worried about now?
Well, the Treasury market is an interesting one. I mean, off the top of my head, it's kind of still money market mutual funds, right? I mean, one of the first things the Federal Reserve did this spring, when it sprang into action, and correctly so at this moment, was they created a facility for money market funds, right? So money market funds didn't get a deposit insurance this time, but they got a facility from the Fed, which is another part of the sort of bank bargain, right? One of the things that you get if you're a bank is the central bank is your lender of last resort. So if there's a run, you can borrow from the central bank. And like, money market mutual funds get that too now, clearly. Every time there's a crisis, 2 for 2 now. Even though they're not banks. And there were some kind of incremental regulatory changes to money market funds after the last crisis, but they were pretty moderate. So, I mean, I kind of feel like it's still money market funds, although it is interesting that the Treasury market, as you point out, is a new interesting one. And like the notion that, you know, hedge funds were in this highly leveraged, nominally, supposedly low risk trade, and they kind of got blown up, and then the Fed kind of bailed them out. I mean, I've been trying to figure out actually if we can do a Planet Money about that. It's like on the wonky end of the spectrum for Planet Money, but it feels big and interesting.
Yeah, you can definitely get that in there. Because there's another interesting line in your book, just thinking about stock markets, where it says stock markets are meant to price assets correctly. They can go up or down, but it sort of feels at the moment where stocks can only go up almost rather than down with the action of the central bank.
I mean, we'll see, I guess. You know, I don't know. I don't know what to make of that. I mean, I know that argument, but like, it doesn't feel like the central bank can infinitely prop up stock prices, right? I mean, there is a simple logic, which is like, well, the central bank's creating all this money and it has to go somewhere and people put it in stocks. But like, is that true? Like, I don't quite know if that's true, you know?
Yeah, I think we're going to go to an audience question because this links nicely to central banking. Francisco's asked, in the modern world where money is trust in central bankers, do you think they should be democratically elected rather than technocrats?
That's a great question. So is it Paul Tucker? There's somebody from the Bank of England, a former Bank of England governor, has been making an argument like that. I mean,
yeah, it's Paul.
Yeah,
it's Paul. I used to work for Paul, so yeah.
Well, I mean, I think I disagree. Like, you know, I will say, like, the Fed has done a better job in the US than any other institution during the crisis, as far as I can tell. And they've done better than democratically elected officials. So, I mean, it's not fashionable to be anti-democratic, I guess. It's a weird stance, but like, I think the Fed is doing a good job, and I think they would probably do a worse job if they were elected. I guess that's the honest answer. But maybe there's a world where even if they would do a worse job, they should be elected. I don't know. Clearly, countries made a choice, right? Central bank independence is a choice, and there's kind of a political valence to that choice. And the sort of historical context is, well, we don't trust ourselves because policy will be too loose and we'll have inflation, right? Like that's the basic central bank independence story. Now, it's weird now because we're in this strangely, strikingly low interest rate, low inflation universe for like 10 years now, right? This is like the great, as far as I'm concerned, sort of monetary fact or puzzle of this era that, if you go back to before the crisis, there was in the US, sub 4% unemployment and massive deficits and super low inflation and very low interest rates. Like, how does that even happen? I mean, I think the Fed has responded though, right? Sorry if I'm going on too long, but like, if you look at the Fed's new policy statement that they put out a few months ago, like they've basically said, look, we're not going to raise interest rates until inflation actually is up. We're not going to try and preempt it anymore. We're going to be basically, lower for longer. So long answer, weird answer, but that's what I think. Yeah.
Because we're taught generally that central banks are always targeting 2% and it goes up. But now, as like you say, it's changing in real time. We're now learning that the Fed are doing average inflation targeting. It's no longer
Richard, I'm curious what you think about that one. I mean, you mentioned that you work for Polteca. You probably know more about it than I do in many ways. Like, what do you think about that question?
Oh, I think a couple of things. I think there's a way that I've been brought up by my education and employment to answer it, which is that, because I worked at the Bank of England for a long time, which is that there's value in constraining a policymaker. And the reason for that is the short-termism of the political cycle. And it's something we see. Actually, I think our politicians have done relatively well in the sense of acting quickly in this crisis, but typically in a kind of normal times, there's the temptation to boost the economy pre-election. And there's loads of evidence that kind of stacks up. So that's the sort of textbook answer. That's what we teach students still. And that's what anyone who's ever worked from the Bank of England has to always say. One of the things I took from your book, though, was that often things aren't as they seem. And that's I really liked your insight and delight. The insight I took is that often things are almost the opposite of we've seen. So you characterize money as it's very formal. It's like the sort of the flag or it's a symbol of the nation. It's like a rock, and we imagine it to be completely legal and formal. Actually, it's completely social, as you put it. It's made up. It evolves in fits and starts. And I just wonder, one of the sort of dark truths, I guess, of modern economics is that we don't really understand where inflation's gone. And is it all to do with these great independent central banks, or maybe some bigger force, per your insight? Could be global trade, it could be tech, is the thing that's actually delivered us this really nice low inflation. It wasn't this whole process of making central bankers independent. That's pretty countercultural, and if I said that in Threadneedle Street, I'd be in big trouble. But I think there might be something in that. I think there's some other big force going on that we're not quite on top of yet.
Thank you. I didn't mean to put you on the spot, by the way. I was genuinely curious. Yeah.
I think also sort of talking about whether we trust elected people to do the right thing, it sort of links to your cautioning against modern monetary theory in some of the later chapters in your book, Jacob. You talk about the fact that obviously we're not seeing inflation at the moment, but can we trust policymakers to raise interest rates or tax rates to cope with inflation? Is there any other perhaps criticisms of MMT you want to talk through? Because it is quite popular at the moment.
I mean, I don't know about, I don't really want to take like a stance on MMT. Yes, in terms of what you said, the particular thing, the particular mechanism that seems like, at least, as an American, as a person who's lived here all my life and, whatever, I know what I read in the papers, like the notion that Congress is going to raise taxes to fight inflation seems far-fetched to me. Like, and it is the case that there's kind of a sophisticated version of MMT that's like, well, have it be an automatic stabilizer. Have, don't make Congress take a vote every time, build some kind of machinery to do it. But even that I find implausible, right? Like depending on tax hikes to fight inflation seems sketchy to me. I mean, there is this weird thing about monetary policy as it works now, which is that like in some ways, despite all of the press conferences on the open mouth operations and the fact that central bankers are much more open than they used to be, until relatively recently, they didn't even say what the target rate was in the US. People would just infer it from their open market operations. So obviously they're much more open now, but still the nature of central banks and interest rate targeting is opaque. Like people don't feel it the way they feel taxes. Like what a tax hike means. Like the Fed raising interest rates, nobody even knows that's happening outside of a relatively small universe. And so there is a way, and again, this is kind of anti-democratic, but there is a way in which that is something of a feature, right? People will fight a tax hike in a way that they might not fight an interest rate hike.
Yeah, I think let's move forward again in time. This is something that quite a lot of the audience might be interested in, is the ascent of Bitcoin is in terms of a speculative asset. But I think what's really interesting in your book is you look about why Bitcoin so far hasn't succeeded and the fact that it was self-consciously trying to be money. Could you talk about what you mean by that phrase?
Yeah, I mean, that's sort of where I land in that chapter, right? So, the striking thing about Bitcoin is a lot of other kinds of money basically became money without anybody realizing it, right? I mean, and it actually happens again and again. Like if you go back to the origins of paper money, a few different times, like first in China and then much later in England, paper money starts out as like a paper receipt for coins, right? Like you deposit your coin somewhere, and like in the case of England, it was the goldsmith gives you a paper receipt, and that kind of turns into money over time. But it doesn't start out as money. Bank deposits are somewhat similar, right? A bank deposit is, it's technically a loan to the bank. And really, as far as I'm concerned, it's not until you have deposit insurance that it's really equally money. Some people talk about the hierarchy of money. And like, once you have deposit insurance, then a bank deposit is as much money as a piece of paper. Again, with the money market mutual fund, right? That's another one where it just started as like, no, it's an investment. But then once the government in 2008 says, okay, we're going to insure it, then it's money, right? So it's these things that start out as like a financial tool, and then without anybody quite realizing it, become money. Bitcoin is the opposite, right? It's people consciously setting out to solve a series of hard technical problems. And they really were hard. It took like 20 years to figure it out, which is quite interesting. And that's most of what I talk about in the book. But the whole time they're like, this is going to be money. And like, it still isn't really money, right? Like in the most basic sense of a thing people use to buy stuff, right? It clearly has a lot of value to people. The market clearing price of Bitcoin is many, many thousands of dollars, but it's not really money, despite the fact that people say it is and that it is worth a lot. It's puzzling.
Okay, I'm just going to go to another audience question from Anna, who's just going back a bit. Actually, you were talking about the tribute economy briefly earlier. And she says, it's somewhat reminiscent of what Veblen described as conspicuous consumption in the American Gilded Age. What do you think monetary institutions at the time of the Gilded Age had a role in enabling the industrial boom and widening inequality?
Well, that's interesting. So, I mean, one of the striking things about that period, at least in the US, I'm not that familiar. Like I read Lombard Street, but I don't know much about, the UK at that time. So let me speak to the US. I mean, a striking thing in the US at that time was the absence of monetary institutions. Like there was no central bank in the US until, was it 1914? I mean, there was one in like, the 1820s, and then we killed it basically and didn't have a central bank. So it really was laissez-faire, basically. John Kenneth Galbraith, the economist and historian, wrote a great history of money. It's a little dated now. It's like very much in the kind of 70s Milton Friedman versus Keynes kind of universe. But he's a very funny, very good writer. And he talks about he basically says there was never such a good time to be rich as the end of the 19th century, because there was no income tax in the US at the time. Sorry, that's my alarm reminding me to do this talk. Just one sec. There was no income tax, There was no central bank. So, I mean, the federal government was almost nothing. It was very small. It collected some customs. There was a little army. So it was really the absence, in some ways, of institutions, I think, combined with this incredible growth of financial capitalism and industry, that allowed for that inequality. And also gave rise to the progressive movement of the early 20th century, right? The backlash to that, and again, this is very US-centric because that's what I know, but it was quite striking. It was where we got the minimum wage and the first, basic safety rules for workers. And I mean, one thing I have wondered, when I was thinking about that Galbraith quote, and he says, like, there was never such a good time to be rich as the late 19th century. And like, he's not alive anymore, but I wonder if, like, now would be a pretty good time to be rich, right? Like, marginal tax rates are quite low, and there's whatever, it seems like a good time to be rich. And I do wonder, in the same way that at the turn of the 20th century, you had this technological innovation, you had electricity was a big one, and the internal combustion engine leading to these giant fortunes, and then leading to a political backlash that led to, the income tax and kind of leveling. I have wondered, like, are we now, we're in the kind of the third industrial revolution, right? Computers and the internet leading to great fortunes. It does feel like there's a potential for a political backlash that is sort of analogous to what happened in the progressive age about 100 years ago, more than 100 years ago now. So that's a fun thing to think about.
Mm-hmm. Well, a great question here from Charlie. And if you do have any more questions for Jacob, please put them in the chat now, because this is definitely the time to ask them. So Charlie has said, the discussion of moving towards an increasingly cashless economy has accelerated during the pandemic. Do you think this transition vests too much power with fintech firms / non-state actors such as Apple and PayPal?
So that's an interesting question. I mean, there's also the question of non-bank actors, right? To sort of to the point before, kind of analogous to what happened in the years leading up to the financial crisis, right? I mean, banks are very much in the web of the state. Banks are not at all in the free market, right? They're this very peculiar institution, and they create money. And so they have this sort of special right. They get a banking charter, but then there are all these obligations. And I think one of the tensions with fintech is, what rights are they going to have, and then what obligations are they going to have? I mean, I will say one other thing that is interesting to me is the proliferation of cash is noticed, perhaps, or under discussed. When you just look at, central bank figures for how much cash is out in the world, it's actually increasing. It's increasing faster than the economy is growing. And that's even true during the pandemic. And I think that's largely just crime driven. There's this economist in the US, Ken Rogoff, who's like a very mainstream economist, who basically thinks like we should definitely get rid of big bills because, in the US, there's $100 bills and $50 bills that you just don't need that much in daily life. But there are more $100 bills than $1 bills, right? There's just this incredible proliferation of hundreds, more than 40 hundreds for every man, woman, and child in America. So as much as people talk about fintech, like, paper money is more abundant than ever.
There's perhaps one country where paper money isn't as abundant, and that's Sweden, which you talk about in the book. Could you talk about that? Because I think that's a really fascinating story if people don't know about what's happened in Sweden.
Yeah. So, as I mentioned in the book, like when I first read that, like, Sweden is kind of at the vanguard of being a post-cash economy, I assumed it was like, oh yeah, Sweden, like the perfect country, right? They do this right and they do that right. And so it's like nobody in Sweden wants to like cheat on their taxes by paying the babysitter in cash or whatever. But that is actually not the case. In fact, there was this like incredible heist where this like very complicated, I think they landed a helicopter on the roof of like this cash distribution center. So there was just this massive robbery of cash in Sweden a number of years ago that led the Swedes to try and sort of move to a post-cash economy. And the banks there developed a kind of a payment app that became widely used. And it's actually gotten to the point in Sweden where now there's a bit of a sort of polite Nordic backlash where they, I think, just passed, it was in process, I believe it did pass a law requiring banks to have cash, right? And so there is some just delight to me in the fact that you would need a law to make a bank have money, right? Or have cash is fun, is great.
Yeah, that's certainly, we're not quite at that point in the UK yet, but yeah, definitely seems to be heading that way, hastened by the pandemic.
Yeah.
Ben, can I ask a question?
Yes, please do.
So it would be remiss of us not to ask you this, I think, Jacob. So all eyes have been on the States over the past week or so. But you come at things in a come at them in a tangent in quite a sort of countercultural way sometimes. So I wanted to ask a question which I'd be really interested in your answer. Given all the things we teach our students, so we teach them about things like labour markets, minimum wages, taxation rates. For those things, of course, there's foreign policy, trade policy, and so on. But how much actually does it matter? How much difference will Bidenomics, if it's a thing, make when so much policy in the US, and it's something I think we sometimes miss at this side of the pond, is actually made at a state level? So the states set the minimum wage and so on. So does it matter what's happened to people in terms of their everyday economics?
So that's a good question. I mean, one important piece of that is Congress, right? And so, the fact that it looks likely that the Republicans are going to hold the Senate is very important in thinking about your question, right? Because if the Democrats had won both the Senate, they're going to hold the House, and the presidency, then there would have been the possibility for more change. I mean, you mentioned minimum wage. There is a federal minimum wage. It's just absurdly low. It's like $8 an hour. I mean, it's extraordinarily low. And so a number of states have set higher wages, but the federal government could set a $15 minimum wage. That would be illegal. There is a minimum wage. I'm actually working on an episode of Planet Money right now, just looking at, what can Biden do without Congress? And it's not trivial, right? I mean, one of the things that's happened in the US over the last, 50 years is Congress has basically ceded power to the president, to the executive branch. And so, and Trump obviously used that to some significant advantage. His sort of chaotic nature meant that he maybe didn't do as much as he could have. But look, trade, that's a big one. I mean, it doesn't have direct, it doesn't feel like minimum wage, but trade is obviously important. As the president has huge powers in terms of trade. And, President Trump basically launched a trade war against China. We have very high tariffs now. Biden could lower those. In terms of energy, there are lots of rules and regulations. I mean, America is a vast regulatory state that basically comes out of the executive branch, in short, right? There's an interesting idea that bank regulators could order the banks to offer everyone in the US just a basic no-fee checking account, which I think is routine in other countries. I don't know what the status is in the UK, but in the US, there are millions of people who just don't have a bank account. And there are very high fees for overdrafts. And so lots of basically poor people end up paying hundreds of dollars a year in overdraft fees. And so the president could order banks to offer ordinary checking accounts. So, I mean, I think the president can and will do a moderate amount. Housing, I mean, there are a number of domains where the president can do a lot and probably will, even without Congress.
That's really interesting. Just on your question, the unbanked is a big sort of policy question that the Treasury and the Bank of England have been thinking about here for a number of years. I guess the slight difference we have, which is a whole other story, is we allowed over the period of 250 years, all of our banks, basically all of them, to just become four. And that's why our financial crash was so bad, because basically two of the biggest ones failed. So we went from 4 to 2. But when you have something like a policy like this, it's quite easy to lean on them and say, listen, we want everyone to have a bank account. So most of them now offer a special bank account for people that find it hard to get banked. So that's an interesting kind of wrinkle in the UK's very concentrated financial setup.
I mean, there's an argument. I've heard Canada also has a concentrated banking sector and has never had a financial crisis. And you may know that, I think it was Calamiris? There was a book basically arguing that concentration in banking might be okay, was basically his argument. I don't know, I can't parse the argument, but it's interesting.
Yeah, Charles Calamiris, and he came to work at the Bank of England after the financial crash as a sort of visiting scholar. I think his argument is relatively common sense, which is that competition drives everything down. You cut corners. One of the corners you cut is your capitalization.
That's interesting. I mean, so it's a kind of an anti-competition argument.
Yeah, it's an interesting one.
Yeah.
Charles Calamere is one of the few people who is actually an academic economist and has run a bank. I think I'm right in saying
that part.
Yeah.
No wonder he doesn't like competition.
Yeah, he was CEO of some bank. Yeah, so maybe he's sort of interested here.
Just to sort of bring it back, because I know we've just got about 5 minutes left, but sticking with the US theme, one of your main definitions at the start is that money is a shared fiction and the social part is what makes it money. I was just wondering, when we're talking about the US here, a lot of Biden's campaign is sort of running on restoring the soul of the nation. Do you think perhaps that social aspect can break down at points, obviously, if Trump had been re-elected perhaps, and whether money is in a stronger position perhaps with a less partisan country?
I mean, that question is a lot. It is the case that modern money is essentially part of the state, right? Like, I mean, money's connection to the state obviously goes way back, and there's this whole argument over how much is, but clearly now money is very much tied up with the state. So essentially what a dollar is backed by is no physical thing, but it's backed by the fact that the United States is a going concern, the fact that the United States economy is functional. And so to that extent, to the extent that you think one administration is going to be sort of make the country be more fundamentally sound, then yeah, in the long run, that would make money more fundamentally sound. Although, I mean, I hope we're not to the point where we're worrying about the dollar as a going concern. I'm worried about a lot, but I'm not worried about that yet.
Yeah, I mean, perhaps, there have been talk about the fall of the dollar as the reserve currency of the world, and perhaps the rise of the renminbi. Do you have any thoughts perhaps on that? Because the dollar has had hegemony for a long time.
It has. I mean, it seems pretty robust. I would think the Chinese would need to loosen capital controls, basically, right? Like, the Chinese economy is clearly getting bigger and more important, but it's not as easy to move money in and out of China as it is to move money in and out of the US or in and out of the UK or in and out of Europe or in and out of Japan, right? So like, there's a reason all these other currencies, I think, are fundamentally more important, and that's that they can kind of just go live in the world as currencies in a way that the yuan or the renminbi can't. And that's another one. I feel silly answering this question because, Richard, I feel like you know the answer better than I do. How did I do?
You did, yeah. 5 out of 5.
Okay, I'll take it. I would have taken 4.
Yeah, you can't really have a reserve currency which isn't freely tradable. And the other thing that's quite interesting on this question, which makes it even more interesting and even more risky, is that what you see with things like this is their networks. So there's value of everybody being on the same network. So everybody's on the dollar. And even when it's time for the Chinese currency, or people used to think it might be the euro, I don't think that's going to happen now, that is good enough to be the reserve currency, it won't quite happen. And at some point, there'll be a tipping point, they call it, where everybody runs the new thing. That's what happened with sterling, the shift from sterling to the dollar back in the 150 years ago. So like, at some point, it may happen and it'll be damn volatile. But, hopefully we'll be used to volatility.
Was it World War I? No, if it's 150, it's longer. What was the moment when it shifted from sterling to the dollar?
1890s, I think. But then there was the sterling crisis after the First World War. So I think sterling dollar kind of had parity between the First and Second World War.
Yeah.
And then, now sterling, I think, is about 10% of global reserves. So it's just gone as a reserve currency.
Perfect. I think we're just about out of time, so I think we'll end it there. So thank you so much for joining us, Jacob. And once again, apologies for the slightly late notice, but it was brilliant to speak with you. I think you've answered a lot of questions, and I hope everyone goes out and buys your book like me and Richard and enjoys it as much as we have.
Thanks so much for having me. I'm sorry I was a few minutes late.
Cheers, Jacob.